How are we doing out there? Hello, everybody. Can anybody hear me? All right. Hey, welcome back. Good to be back. Good to see you here. Ed Ponsi here, your FX educator. Here on behalf of FX Street once again. Sorry about that little technical issue. We're back and ready to go. So starting up a few minutes late. Obviously, we'll be running a few minutes late, so don't worry. We'll get a full schedule in, and we have two shows today. One starting now and one starting a little less than an hour from now. So do feel free if you do have questions. Just enter them in, type them in, and press enter, and I'm more than happy to try to answer any questions for you. Of course, it's only really about one thing today anyway, and that one thing is that the move in oil overnight, over the weekend really, after that meeting in Doha failed. So just so you're up to speed on this, I'm sure some of you are already aware of this, but there was a meeting over the weekend. A lot of the big oil-producing nations were getting together in Doha and trying to come to some kind of an agreement about putting limits on output, and they did not. They failed to do so, and that should come as a surprise to no one, really, because if you saw the price of oil on Friday going into this meeting, big red candle on oil tells you, right, in advance that this is going to fail. I mean, how it couldn't be more obvious that there was a problem going into this meeting. And so now that problem is very obvious to everyone. But really, you should have known about that on Friday based on the price action going into the meeting. The price was moving as if it was already known that that no agreement could be reached. And, you know, these countries that are involved, like, for example, Iran, right, is just putting their oil production back online, and is it any big surprise that they don't want to participate in placing limits on their output? You know, so it should come as no surprise. So that was a huge gap in oil, currently hanging right around $40 a barrel. Could certainly get back down to the 37 area, I think, you know, over the next week or so. You've got to believe that a lot of the momentum that oil recently experienced, the bottom really occurs when first word of an agreement on an output freeze, right, occurs about, you know, back in February. And now that's all going by the wayside. You know, some people think that we can go all the way back down to here, you know, into the low 30s. I'm not quite that optimistic, but I think we could get into the lower mid 30s. The 37 area, I think, is very doable for oil. So what does that have to do with the currency market? Well, take a look at dollar Canada. Canadian dollar has been getting stronger lately. And now we're seeing Canadian dollar getting a lot weaker today, and a big gap. You don't see a lot of intraday gaps in Forex, and obviously Sunday night gaps are the most common. But the Sunday night gap we saw last night for Canada, look at this. I mean, that is a significant gap. And people want to know, well, how do you trade that, Ed? I mean, because is there a philosophy for trading this gap? Is there a standardized method? I think we can say the answer is yes. So what I'll do, I'll pull up a Word document so you can, you know, play along at home, and we can do the math together. And what I do is sorry about that, I have a little template that I want to share with you about how to trade gaps. And like I said, you know, we don't see them that often in Forex, but when we do, it can be significant. So I'm looking at this gap, and it's approximately 100 pips. right? It goes from about 128.20. And I realize if you look at that in a different time frame, it's going to look a little bit, it's not going to look exactly the same in every time frame. But I think on the shorter time frame, you're getting a truer picture of what actually happened. So let me get rid of one of those. So from 128.20, really it's going to gap up to here, 129.50. Let's just say 128.20 to 129.20, that there's an area in here where the price is untouched. And the way I like to imagine it is that there are all these orders left behind. Some of them are big orders. Some of them are small orders. They're not all at the same price, right? And what do we know about banks and brokers? How do they make money? Banks and brokers make money when orders are filled. I'm not talking about your currency broker. I'm not talking about Oanda or FXCM, although you could certainly say that that's true about them as well. But they don't rule the market. The institutions rule the market. Right? The retail brokers do not. The institutions are the ones that rule this market. Do they control it? No, nobody controls this market. It's too big. It's too big to be controlled. But just imagine that there's a huge price gap here, 100 pips, really more than 100, but we'll just stick with 100. And we'll say, you know, all these orders are left behind. Now, Forex brokers, forget about the retail. Again, let's go to the institutions. Let's say that I work for JP Morgan and Phil works for Goldman Sachs. Who else do we have here today? Phil's with Goldman Sachs. I'm with JP Morgan. Abdul is with UBS. Sound good? Now, I work at JP Morgan. I know where my clients' orders are because part of my job is to get my clients' orders filled. So we'll say that the black X's are my orders. I know I have orders in here. Now I call up, or maybe I send a text over to Abdul over at UBS because I know I want the price to come in here. And I call up Abdul and I say, hey Abdul, do you have orders in between 128.20 and 129.20? Orders that you'd like to see filled? And he says, yes, I do. And we'll represent. So he's telling me, maybe he doesn't tell me exactly where they're located, but we find out that, you know, UBS also has orders in here that need to be filled. And maybe Abdul sends a message. How do I know Abdul? Well, you know, we work at different companies now, but we used to work at the same company. At one time, Phil, Abdul, and myself, the three of us, were all on one trading desk. We were all newbies. We were all assistant traders at Bank of America, let's say. And now we all got hired away by different companies, but we still know each other. Abdul sends a text over to Phil and says, hey, Phil, do you have any orders between 128.20 and 129.20? And Phil says, as a matter of fact, I do. And Phil's orders are represented by the letter, let's go with the letter T, because that's what I clicked on. Again, some big orders, some small orders. The point of this exercise is twofold. For one thing, institutions are not monolithic. They do not place all their orders at the same place. They do not all trade exactly the same way. But they all have one thing in common. They do not like to have their customers' orders left behind. So, Now, if the market, if it's this time of day, such as it is right now it's 8 a.m. in New York, and that means it's 1 p.m. in London. You have the two biggest Forex markets in the world are open right now and trading and banging away. These are limit orders, okay? Now, why did they not get filled with the gap? Again, these are not retail orders. These are not orders at FXCM or Oanda or Gain Capital or TradeStation. These are orders at Citibank. These are orders at Goldman Sachs. These are orders at UBS. So you have to sort of get outside of the whole idea of how the retail trader exists and try to think about the institutional trader. If those are limit orders, those limit orders may be unfilled. Okay, and if you have, so let's just say that we've figured out there's a lot of unfilled orders. All right, so when prices gap, in other words, consider this. In order to understand this, there's one thing you have to think about. Not everybody who's in the Forex market is in the Forex market to make money trading Forex. In fact, the vast majority are not in the market trying to make money trading Forex. The vast majority are companies that are trying to do business. So this is dollar CAD, right? So maybe I have an oil producer in Canada and an oil buyer purchaser in the United States. And they need to keep their, they need to hedge. But that's not even a good example because oil trades in US dollars everywhere. How about lumber, right? There are all these huge forests in Canada. And if I'm a home builder in the United States and I get my lumber from Canada, the one thing that I really fear is a strong Canadian dollar. I have to hedge against that, right? That's the one thing I fear as a producer. But if I'm building houses, maybe I just need Canadian dollars today. Maybe I just need Canadian dollars to buy lumber. And I call my banker. I call my banker at UBS or at JP Morgan, and I say, listen, get me as many Canadian dollars as you can at a particular price. Or exchange US dollars for Canadian dollars at 128.60. It's a limit order. But it's not like your limit order and my limit order. They're not traders. A home builder needs Canadian dollars to buy lumber, to build a house. That has nothing to do with trading, right? But 3/4 of all the transactions in the market are exactly that. It's companies doing business with each other. So if I'm General Electric, right? I'm General Electric. I need yen because I need to buy some electronic component from a Japanese factory. I need it for my toaster ovens. I'm going to sell 1 million toaster ovens today, and I need this chip, and I get this chip from Japan. I need Japanese yen, but I want to get it at a particular price. My order isn't going to get filled because the market gaps. I'm not a trader. I'm General Electric. Okay, it's a whole different ball game, whole different game. And I'm glad you asked that question because it's important to understand that the vast majority of the money that's going around trading Forex has nothing to do with speculation. You and I are speculators, right? We speculate on the euro is going to go up and down or the yen is going to do this or that. The vast majority of the action that happens on an institutional desk, these are orders placed by companies. They're orders at specific prices. They're not going to fill with the gap. The gap to the institution means that money has been left behind, left on the table, and there's nothing that they hate more than leaving money on the table, right? So there's a way we can trade this as retail traders going through FXCM or going through Oanda. And I didn't do this trade last night. I was preoccupied. So I have no idea if this is going to work, but I'm going to throw it out there anyway. Let's say that we have a gap between 129.30 and 129.20 and 128.20. So 129.20 minus 128.20 equals 100 pips. Let's make that nice and big so everybody can read it. By the way, I always leave the decimals out when I'm doing math. The decimals can really throw you off, right? So we know the size of the gap is approximately 100. The next is 100 times 0.1, 10% of the gap, equals 10 pips. So far, so good. This template runs off of the size of the gap. And because of that, the template should work the same way regardless of the size of the gap. So this is a 100 pip gap, and I'm going to give you a template that should always result in a 3-to-1 reward to risk ratio. Sound interesting? Okay. So, by the way, great questions so far, everyone. Very good. We said 10 pips. My entry is 10 pips below the upper end of the gap, which we will call support. So the upper end is 129.20 minus 10 pips, 129.10. I'm going to drop a green line at 129.10. And the reason why is because, you see, I know that even though this is a very difficult market to manipulate, I know that if it's late at night, these banks and brokers, and if the price is very close to the edge of this gap, the banks and brokers might try to push the price down into this area, what we call a stop run, in order to try to execute these orders. Does that make sense? They might try to get these orders to execute, because we know we have 3 different people from 3 different investment banks are sort of communicating. They know each other from way back when, and they might be conspiring to create a move during the dead zone when it's really, really quiet out there. That's probably when they say, well, if we sell enough dollar Canada during the dead zone, if the price is close to the edge, we might be able to push it into here. Now, as a retail trader, I don't know that that's going to happen, but I can plan for it. Now, we already have the entry, right? The stop, remember, everything is based on 10 pips. That's 10% of the size of the 10% of the size of the gap. The stop is going to go 10 pips above, 10%, 129.20 plus 10 equals 129.30. All right, so this is my entry. Make that green. And this is my stop. Make that red. And you can see that we have an entry at 129.10, a stop at 129.30. So we'll try to drop a line right about at 129.30, and this is where the stop will be located. We'll make that a red line. So that's why the gaps get filled so often so quickly. Yeah, they have Now, listen, this does not happen in every occasion, but the banks have, let's put it this way. We know they have an incentive, right, to get these orders filled. Ed and Phil and Abdul are kind of, maybe they even say, hey, when it gets to the dead zone tonight, like at 7 minutes after the hour, let's all hit the sell button, right? And we'll try to set off these orders. And now let me tell you something. If they're able to set these orders off, will they keep pushing it? No. They're going to allow the price to come back up. Once, it costs money to move the market. It's hard enough to do it even during the best of circumstances. The easiest time to move the market is when there's nobody around, when there are very few buyers and sellers. Okay, so we have our entry and we have our stop. We need targets. One of our targets, the lower end of this border is 128.20, right? 128.20. And this time I'm going to say 128.20 plus 10 is 128.30, and that's going to create a target. I'll change the color of this to blue. So we like to keep everything color-coded, right? Entries, green. Stops, red. Targets, blue. Everything running off of the template, 100 pips is the size of the gap. 10 pips is 10% of that. So the entry, 10 below one border. The stop is 10 above the other border. So the stop is going to look like this, 128.30. And by the way, this is not just for Forex. This could be used to trade anything, really. So I have an entry in green, I have a stop in red, and I have a target in blue. Now, if you know me, you know that I like to use multiple targets. Like, I'm all about multiple targets. And whenever you're talking about either gaps or sideways trades or range-bound trades, people are always trying to play it from one side to the other, sell it here and buy it here, and we're kind of doing that too. But an easier target is right in the middle. The easy target is halfway between 128.20 and 129.20. So who can tell me what is halfway between 128.20 and 129.20? What number is halfway between? Come on, I know it's Monday, gang. Get your coffee up. 128.70 is correct. DIAC. 128.70. The halfway point is a good and sensible target. Now, if you think about it, let's talk about risk reward here. The risk here is 20, right? Because 129.10 up to 129.30, right? That means risk equals 20. By the way, let's put that second target in here too. 128.70. So I'm risking 20 pips. My first target is 128.70. So if I'm selling short at 129.20 and my halfway point, that's actually incorrect. I'm selling short at 129.10. I'm selling short at 129.10. And I'm shooting for 128.70. How many pips is that? From 129.10 entry to 128.70. How many pips is that to the first target? 40 pips. Okay, so if it hits the stop, I'm going to lose 20. If it hits the first target, I'm going to make 40. My first target, what's the risk to reward ratio? What's the reward to risk ratio on my first target? If I win, I get 40. If I lose 20. What's my reward to risk on target 1? 2 to 1 is correct. I've got a 2 to 1 reward to risk ratio on the first target. So that's T1. Now, T2 is this guy here. That's 128.20. Plus 10 is 128.30. So how many pips is that? If I can sell short at 129.10, and if I have a target of 128.30, how many pips is that? From 129.10 down to 128.30. That's 80 pips, correct. 80 pips, and the reward to risk on that part of the trade, the risk is 20, the reward is 80. What's the ratio, reward to risk ratio, for the second target? 4 to 1. Now I have two targets. Right, so here to put it up here, this one would be 80. So I have two targets now, right? 4 to 1 and 2 to 1. If you average those two targets out, what do you get? I have a 2 to 1 target and a 4 to 1 target. So what's the reward to risk for the overall trade? Abdul has the correct answer. It is 3 to 1. The beautiful thing about this template is you always get 3 to 1 reward to risk. If this is a 200 pip range, right? If this is a 200 pip range, then 200 times 10% is 20 pips. The entry is 20 below. The stop is 20 above. Target 2 is 20 above the bottom of the range. And target 1 is the halfway point. It's always going to come out to 3 to 1 every time. Now, what happened in this particular case? Nothing much. Nothing much. It looks like nothing happens. There's the entry. There's the entry right there. Now that entry occurs at the London Open. So it's a high volatility time. There's the first target. It hits the first target. When it hits the first target, we bring the stop down to break even so that we know we now have put 40 pips in our pocket and we're stopped out, break even on the second half of the trade. So the result in this case, 40 pips profit on half the trade, break even on the other half. That's how you trade gaps, ladies and gentlemen. And you could use that for anything. Now, in this case, it was not a stealthy move that happened in the middle of the night. But you can bet if those orders were still sitting there, Phil and Ed and Abdul would be having a little chat this afternoon, okay, to try to figure out a way to get those orders to hit. Okay, I hope you enjoyed this presentation. That was a little bit different, right? And we're going to come back in 20 minutes with another presentation on the current market, So be sure to come back for that. I'll be back in just 20 minutes. Until then, this has been Ed Ponsi, your FX educator, saying thank you for listening. I'll catch you back here in 20 minutes. Thanks for listening.